Welcome to the current federal tax developments for December the 15th, 2025. Current federal tax developments are brought to you by your state society of CPAs. We're going to be looking at this week a mix of finalized regulations, some pending legislation, and some court cases we'll be looking at in today's session. So we're going to start out today by looking at some procedural changes that go into effect almost immediately, December 24th, you have till Christmas Eve. And this is by the U.S. Postal Service finalizing a rule regarding postmarks that codifies what they refer to as an operational reality. The date a machine stamps your envelope may be later than the date you actually dropped it off with U.S. Postal Service. Right? This creates a significant risk for the treatment of the timely mailing is timely filing rule under 7502, especially for clients who do not decide to make use of certified mail. We're going to talk also about a bill that is now on the president's desk, H.R. 1491. It's a technical correction that we probably needed for a while, and we kind of learned we needed it during the COVID-19, well, I guess, disaster, right? Technically, it was a national disaster. And this is to basically fixes a glitch where disaster postponements stop the late filing penalty clock, but didn't actually stop the refund statute of limitation clock from running, which we ran into with COVID. So this bill, once signed into law, will synchronize the relief we get for disasters under 7508A with the 6511 refund claim dates. In essence, to make sure that if we get a 3-month extension of time to file the return, we're going to, at the back end of the statute, get a 3-year statute of limitation extension to file our claim for refund. We're going to talk about a case called Temnorod, we should say. This is a case review. It's a tax court memorandum case that serves as a harsh refresher on the hierarchy of the code. Capitalization is the priority. That's the norm. Under 263, it will trump a deduction under 162. We start with capitalization, the default under the code. That's how this runs. The court also reminded us that if you're a service provider, you can't really have cost of goods sold. And we'll talk about that as well. We're going to talk about on the benefits side, we're going to talk about Notice 2026-5. And that looks at changes from the One Big Beautiful Bill Act. And this includes permanent telehealth safe harbor and a major change that allows direct primary care, the concierge-style fees, to be paid via HSAs. We'll go on to an e-commerce case in this, which is a California case, Diet Standards LLC. And this confirms that holding inventory in an Amazon, basically warehouse, which often is used, for your shipping, is going to be active engagement in the state. And that's going to trigger filing requirements and minimum taxes, in this case, $600 LLC minimum tax, because the client is doing business, even if that client is below the economic nexus thresholds in California. And since California is a big state, this involved a Delaware entity that had minimal sales in California, which is probably one of the more significant issues. And finally, we're going to close with the case of Mirch, which is a cautionary tale about real estate professionals. We haven't had one for a while to talk about on here. Haven't pulled one up, so I thought it's probably a good time to go back and remember, in essence, that ballpark guesstimation doesn't work, and on-call time in the taxpayer's logs is also not going to work. It's an example of what not to do when you're trying to substantiate material participation as a real estate professional. With that, let's go into details. I'm going to start with the new United States Postal Service rules. These rules, which are found in the Federal Reserve, or the Federal Register, I should say, document 2025-2740, that was published in the Register on November 24, 2025, that amended Title 39, the Code of Federal Regulations, Part 111. Get all that out in case, right? So we're going to start with this procedural change from the U.S. Postal Service. It goes into effect on December 24th, 1 month from the date it was published in the Federal Register. This amends the Domestic Mail Manual, and it regards postmarks and postal possession, which seems like, well, why are we talking about this in tax? Obviously, we understand quickly there's a big reason. The critical role for us in taxes is we rely on the postmark dates, basically the postmark rule for timely filing under the mailbox rule. And the main reason why we rely upon the postmarks in this structure is we know that certified mail, registered mail is a better way to do it, provides the actual proof. But we also know that, 90% of our clients are going to ignore that and just mail the envelope. The core takeaway, though, is that because of this United States Postal Service change in how I define and apply postmarks, this creates a risk that returns mailed close to the deadline may end up be deemed late. So let's take a look at this rule in a little more detail. Now, this new rule is very explicit. A postmark confirms the United States Postal Service has the item on the date stamp, but it does not any longer confirm that is the day they received it, right? This is in here. It adds section 60811 to the Domestic Mail Manual to cover this point. The Postal Service is clarifying that not all mail postmarked in the ordinary course of business is immediately done upon receipt. Rather, what's happening now is it's codifying their operational reality, and a reality that we're dealing with now because we just recently relocated our firm. We have some mail forwarding fun going on right now based upon this new operational reality of a regional postal center, where they process things these days, and then the local post office, which in many ways now is kind of just like a retail location. Well, you can talk with the Postal Service there, but the work is actually going on elsewhere. So the operational reality we have now is this mail is often moving from their retail unit or collection box, whether it's from your local post office or to a collection box, the mailbox you put it in, to a processing plant before it gets stamped. This movement takes time, and there's no guarantee that the day you hand the letter, even if you drop the letter in the mail slot at the post office, there's no guarantee that it's going to be postmarked that day. That makes a big difference on tax because the statutes for taxes tell us that we're going to rely upon that date. So this is what's dangerous, right? It's not the local post office drop box unless certain steps are taken, steps that are going to be to the client virtually as inconvenient as doing certified mail. There just won't be a charge. With the regional transportation optimization and leg-based service standards, these are the changes they've made. They're moving mail further along in their system before it gets processing done. At this point, here in Phoenix, used to be we would take our mail in the old office that we had to the Arcadia. It would go to the Arcadia post office, and postmarks would be applied there, and basic structure started. That's not happening anymore. Here in Phoenix, if that letter is going to go to a processing plant that is much further away on Buckeye Road, and it's going to the same place even at our new office, which is one zip code over, right? And so it doesn't matter, right? It's going to go to that centralized location. So if a client were to drop a return in a blue postal mark box at 4 p.m. on April 15th, it might go to a regional center and not get stamped or scanned until April 16th. It may still be picked up from the box at 4 p.m., but there's no guarantee it's going to go, it's going to get processed that night as it moves around. And the Postal Service actually admits in the preamble that the postmark is not their term, perfectly reliable indicator of the mailing date any longer. That's a big change clients have to understand. Because as I said, our problem is clients tend to ignore the issue about using certified mail. And our problem comes under the Internal Revenue Code, Section 7502. The postmark date on the envelope is deemed to be the delivery date if that document arrives at the IRS after April 15th. If that postmark says April 16th, that return under the law is late, even if the client swears they dropped it off on the 15th. And that's considered a big problem. So we have no current relief guidance from the IRS acknowledging this, quote, United States Postal Service, we're going to recognize reality processing lag regulation. The only prima facie evidence of timely mailing, under the reg is a certified or registered mail receipt stamped by a U.S. Postal Service employee. This rule remains the gold standard. This rule still works. But clients don't like the rule. That's always been our problem. If you seriously don't want to pay for it, let's say their concern is, I don't want to pay for certified mail, and you want the same level of comfort, which isn't at all perfect, that you got previously by dropping it off at the Postal Service like at noon on April 15th, by just dropping in the mail slot there and walking away. There are some ways we could do this. The rule outlines how to guarantee that the correct date's on the envelope. Now, remember, having a correct date on the envelope is not necessarily perfect, because one thing certified mail gives us is a presumption of delivery. None of these will do that. And if that document doesn't get to the Postal Service or doesn't get to the IRS, then there is no postmark they're going to look at. There is no proof of mailing. And if it eventually gets to them with the right postmark date, then yeah, we've got it. But remember, this is imperfect proof, but there are ways you can assure the postmark on the envelope at least is the day you dropped it off at the Postal Service. First, you can walk in and take your letter to the counter and request a manual postmark at the counter. This is free of charge. The rule is very clear that there's not going to be a charge if you ask for that. Okay? Not necessarily the most popular thing for the client to do, but they could walk it in and get the manual postmark. Second, if they decide to buy the postage at the counter, then that label, the sticker they put on the envelope, it counts as the date of acceptance. So bottom line, that's considered a postmark. Per the Postal Service, that's what it is. Third, you could buy a certificate of mailing. Now, as a practical matter, the third doesn't really help us much, because again, that's not going to really help the situation, right? If it doesn't get there. The manual postmark or the postage validation, imprint, PVI, which is when you buy the postage from them, those are likely the best two options if a client does not want to pay for certified. I would caution them about certificate of mailing is mentioned in the reg, but remember, it is not useful for our purposes. And also note the volume warning. If you're one of those people that still prints out your electronic extensions, and so, you've got 150 extensions to file April 15th, and you're going to drop off 150 extensions at the Postal Service for manual postmarking, you got to call the manager ahead of time. Don't do that. Bottom line, think about using the one big envelope, right? If you're going to actually mail them in, which I wouldn't suggest doing, but if you're going to do that, or do it electronically. But yes, if you're doing any volume mailing, right? And like I said, the most likely is going to be when you're down there mailing extensions. If you're still manually mailing extensions, you're going to have to, if you've got 50 or more of them, you've got to call the manager ahead of time in order to get that to work. That's simply going to be the issue. Now, things not to do. Clients love click and ship or Pitney Bowes meters, but the rules warn those only prove when the label was printed, not when the Post Service took the letter. The regulations under, basically 7509 do provide some rules for postmarks that are like by postage meter. But the catch is the IRS has to receive that letter within the normal time for delivery had it been actually mailed on that date, which means they are useless, effectively, for being able to prove that you actually mailed it on time and the Postal Service didn't just kind of, hide it. Don't drop tax returns basically in a blue collection box on or near the due date of the return. The risk of a late postmark is now codified in the regulations, right? You've been told if you walk up and you just drop it in a postal box or you give it to your carrier and we're running up on the deadline, there's a reasonable chance there's going to be a day late postmark applied. And that's going to cause us problems. So if the client is going to be, the client's going to mail close to the deadline, they have to, at a minimum, walk to the counter and ask for the manual postmark, or do the PVI routine and buy their postage at the counter, or they need to get certified mail. And I'm going to tell them, if you're going in, I know it costs you a little bit, right? But the protection you get, and you're walking in anyway, get the certified mail receipt. But be very, very careful and caution your clients about the huge, huge downside now of just dropping it in a mailbox anywhere close to the due date. And by the way, this is not just a federal tax issue. Many states, localities will use the same thing. States will use it for their, tax filings, for income taxes, and a lot of, counties and other taxing entities for property taxes will use the same thing. And again, that postmark date may be a day late. So strongly consider electronic payments or doing things that skip, right? You can skip a lot of this by electronic filing. This is another reason why clients should probably heavily consider filing their returns electronically. Now we're going to move on to some legislation. In this case, we're looking at H.R. 1491, Disaster-Related Extension of Deadlines Act. It passed the Senate on December the 11th of 2025 by unanimous consent. It passed the House way earlier. And it is on the president's desk right now awaiting signature. At least it was as of late Friday. And I'm going to assume that I'm recording this on Saturday. I don't think he signed it this morning. So I'm going to think that, probably we're still waiting the president's signature. This is effectively a technical correction bill that fixes two major glitches regarding disaster relief: the refund statute of limitations and the premature collection notice issues. Okay, so we have those involved. So here's the trap that we have. 7508A of the code provides a postponement, a disregarded period, when certain disasters take place. There is a mandatory period, which is going to be expanded to 120 days under federally declared disasters. And then there is up to a year when the IRS, the Treasury grants an extension of time. That time is a postponement for late filing, but Section 6511, we're asking to file a claim for refund, looks for having a true extension of time, which this is not. So if a disaster happens and the deadline is moved to, say, a different date, let's say the deadline becomes June 15th, or let's say June 15th, the taxpayer filed on June 1st, 3 years later, they might be timely filing the return, but that return is treated as filed on April the 15th, right? So withholding paid on the original April 15th is now outside the 3-year look-back window. And since you didn't have an extension to file, if you don't file your amended return, your claim for refund by April 15th, 3 years later, so let's say there was a disaster that occurred right today, it extends the time for filing your 2025 return until June, let's say June 15th of 2026. You've got to get your, with the law before this change, your claim for refund had to be received or to the IRS by April 15th of 29, not by the date you actually filed the return, June 1st, let's say, of this year or next year, if that's the date you file it. Because it's still considered filed April 15th. That was a big flaw. So you can file a timely return, but be time barred from getting your refund. Because essentially, you're within 3 years of when you filed the return. That's what we always tell people, right? 3 years of filing a return. But because that return is now moved back to April 15th, normally we move the return forward to April 15th if we filed before the April 15th deadline. This rule, we're going to pull it back, is how 7508 worked. It was weird because it was not an extension. Now, H.R. 1491 will fix this by adding a subsection F to 7508A, and that explicitly states a discarded period shall be treated as an extension of time to file for purposes of Section 6511. And that's going to be useful because now, with that in place, assuming that the president signs the bill, if we did get that extension till June 15th next year, what will happen is, and let's say you filed your return June 1st, as long as you got your claim for refund in by June 1st of 2029, you'd be timely filed. Because this is now an extension period, not the period before the due date, which it's a clear drafting problem with the law. There's no question. So this will now synchronize the filing date with the refund look-back period. And as I say, the way it works. Now, right now, if you're sitting on a claim for refund right now that would be affected by this, it does apply only to claims filed after enactment. So, you might want to, as long as you might want to, if you're sitting in that middle period. Yeah, I don't know anybody really is right now, although I've had some weird extensions. that have pushed things into the following year. The year following, so not into 26, but all the way into 20, let's say into 27, the extension could. You might want to wait to pull the trigger. On COVID, the IRS did waive this period administratively, but this solves that problem. But again, only applies to claims filed after date of enactment. That's going to be the date the president signs the bill into law. The second problem was an administrative one for the IRS. The IRS computers are programmed to send demand letters under 6303 based on the original deadline. So when a disaster hits, the computers often don't catch up, and disaster loan clients can get demand letters even though they have a postponement, involved. Erroneous demand letters are in place. So this amends 6303B to force the last prescribed date for payment to account for the disaster postponement. That makes it illegal for the IRS to issue those premature notices, and of course, they need to now get their systems up and running to do that. But effectively, because they cannot issue that before that particular date. So what this act does is in many ways kind of just puts a pause button in, right? We're going to pause this and stop the clock from running to make it work correctly. Before, the pause button only stopped the late filing penalty. Now it pauses late filing penalty and the related refund clock and collection notice clock as well, right? So when the president signs this bill should take effect. There's no obvious reason we see why the president won't be signing it, so we're going to assume somewhere within the next couple of weeks we'll probably get it. Usually they let bills sit on the president's desk for a little while. The main reason is so staff can review it to make sure there's nothing in there that nobody's caught, right? One last review before signing. So presuming nothing's found, we should have some relief here shortly. Next up is a case of Temnorod versus Commissioner. Tax Court Memorandum Decision 2025-127 came down December the 8th. Now, this is a case involving capitalization of an item versus deducting the item. So this is a refresher on the hierarchy. When does Section 263 required capitalization apply? And that the fact that it generally will trump a 162 deduction. If an expense is both a 263 capitalization item and a 162 item, generally 263 is going to beat it. Okay, with that, let's take a look at the case background. Now, Broadvox, an S corporation, bought the assets of a recently bankrupt related company, Info Telecom, I should say. Now, this involves, and you can read the case, it involves essentially agreements that related to payments for carriers to carry long distance coverage. It goes way back. But these are, to get these assets, though, the carrier agreements that they had, Broadvox had to pay off Info Telecom's debts to Verizon and AT&T of about $3.5 million in cure costs, because there was a dispute over how much the old company, which was related but not really part of Broadvox, had to pay. It went around the weird way long distance used to work, right? Now, Broadvox tried to write this off immediately, and on their tax return, they wrote this off as cost of goods sold. They're an S corporation provider of VoIP services. And, well, it's kind of weird. They're a service provider. It's like cost of goods sold. Okay. Now, the taxpayer argued first that it's cost of goods sold. That's what these payments were. It was cost of goods sold in their view. And secondly, if it's not cost of goods sold, it's a ordinary necessary business expense under 162 that was required to protect their business, right? So they should get it. They claimed if they didn't pay, the carriers would have sued Broadvox directly, or they would have killed the business, right? You'd have been unable to make long distance calls because not all of the people you're calling are going to be Broadvox customers. In fact, probably very few are. So they really need to be able to transfer calls to those other providers like AT&T, Verizon, etc. Right? So it was a defensive expense to prevent a forced liquidation. Now, what we have here, though, is the court essentially, first thing they said right off, cost of goods sold argument absolutely doesn't work. You're not a manufacturing, you're not like a service provider, you're not a retailer, you're none of those. your service providers cannot generally have cost of goods sold because you don't produce or sell merchandise. I mean, exactly how would you have inventory is kind of the first question. How would we inventory this cost? Because that's really what cost of goods sold is, right? Things that are kind of inventoriable costs, plus things like freight. But it's like, this is just a one-time catch-up fee that from before. They're saying, nah, this is not cost of goods sold. You don't get that option here. Now, on the question of 162 ordinary and necessary business expenses, the court reminded them of what we'll refer to as the ordering rule. Section 161 tells us that deductions are allowed, so these are the general business deductions, including Section 162, are allowed subject to Section 263. If an item fits both, capitalization wins, right? That's the key takeaway. The court is applying, in this case, the Webb principle. If you pay a prior owner's debt to acquire their property, that payment is part of the purchase price, the basis, not an expense. This was a payment, essentially, to acquire the assets of the other company. And it was an intangible asset. It is not a ordinary and necessary expense. It was part of the purchase, right? That's the simple test set. Based on that, this is a 263 little a acquisition expense, right? It was what made the acquisition go. We acquired the asset. Under the regulations under 263 little a, it's going to be capitalized into the intangible asset that was acquired. So the court notes that, under the contract, the form of the transaction said that when under the agreement, asset purchase agreement they signed, they said these cured costs were outright assumed liabilities. So again, going back to Webb, you're assuming liabilities to get the assets. That's part of the asset. Even if there was a dual purpose protecting the business, the origin of the claim was the acquisition of the assets. Form over, substance over form doesn't generally work when the taxpayer is the one trying to assert it. And that was effectively what they were trying to assert here. That I understand the form says we took these, we're paying off these liabilities. That's what we agreed with, to get these out of bankruptcy, to get AT&T and Verizon to sign off. We agreed to that. It's like, but see, that's not reality. It's like, well, the IRS can assert this because the IRS was not a party to the agreement. As a party to the agreement, your client generally can't assert it. So the result was the $3.1 million must be capitalized. They cannot claim a current deduction for those amounts. Okay, next up, let's take a look at the benefits, right? So we're going to start now with the One Big Beautiful Bill Act that made changes to health savings accounts. And notice 2026-5, which was issued on December 10th of 2025. It basically explains these particular, changes that were made. So there's actually, first, we start out with good news for telehealth. This safe harbor allows high deductible health plans to cover remote care before the deductible. That was something that was added temporarily during COVID. I believe the CARES Act started it. And then it was continued on, but it was set to expire at the end of this year. This has now become permanent. So a high deductible health plan can cover telehealth visits with your physician, and that will not be an impermissible coverage that would make it not a high deductible health plan. Now, the effective date is retroactive to January 1st of 25 because this actually had expired. Now, this applies to remote services only. It doesn't magically make non-remote prescriptions or in-person visits deductible free. It only covers telehealth visits. So this is an interesting aside that your insurance can provide coverage for telehealth where you visit the doctor, let's say using your computer, but it cannot. But if you decide, oh, it's not working, I'm going in to see the doctor, this doesn't cover that, right? If it provided coverage for that, it would not be covered under this exception. Also, the rules now fix a longstanding issue where bronze and catastrophic health plan could fail to be HDHP testing because they had high out-of-pocket maximums beyond what's normally allowed for a high deductible health plan. Starting in 2026, these plans will officially qualify as high-deductible health plans. This is a bronze or catastrophic plan that is available on the exchange. If you buy that, that's an HDHP by definition. There's a Reliance safe harbor. Also, even if you buy off exchange, if you buy off exchange and you have no reason to believe it's not also available on the exchange, it's safe. Obviously, it's safer to get it from the exchange rather than getting it, because obviously the question is going to arise: why do you get it off exchange? If it's on the exchange, and the way to be sure to get this, get it on exchange. But there is a safe harbor, so if a client does that, you just got to be able to mandate to do that, to basically, I'll get my words out right, to just document that they had no reason to believe the opposite. And again, this doesn't solve a problem for 25. If they had a bronze or catastrophic plan that was not HCHP, and they're trying to make a contribution for 25 to their HSA, yeah, that doesn't work. But it will be effective next year. We also made a change to direct primary care, the concierge doctor, right? Concierge light medicine, shall we say, where you pay an access fee to the doctor and you get certain things during the year. That used to disqualify you from taking health savings accounts because it was considered other health coverage before the deductible kicked in. And again, you can't have disqualifying coverage. If you have disqualifying coverage, you cannot contribute to an HSA. Now, these arrangements are disregarded, which means we can allow them if the fee's capped at $150 per month per person or $300 per month if you're covering multiple people. Now, there are a couple of caveats here, and that fee cap is one key caveat, right? If your doctor's charging more than that for this service, then it's going to disqualify you from being able to contribute to a health savings account. Now, there is a weird thing here. We talk about the rules involving, if you have employer funding, you can use HSA money to pay these fees. They are an exception to the no premiums rule. However, if the employer pays the fee, it's tax-free to the employee, but it's not a qualified medical expense, right? No double dipping. And again, if the fee is over $150 per month, the whole arrangement blows up eligibility for an HSA. So you got to watch it. Now, I don't know if all of these programs got the note about the cap on the fees and how they're going to arrange that, probably by, reducing, modifying services at this level. But, if it's $1 over $150 per month, that whole thing is disqualifying coverage. So you got to be able to keep it down. So again, telehealth, remember your dates here. Telehealth is retroactive to the start of 25, but the bronze plan rules and the special rules for concierge payments, they don't start till next year. Now, there are comments requested. If you have any comments on this before regs are written, and they're asking for those by March the 6th. Now, let's take a state and local tax update from California. I realize this is federal taxes that we talk about here mainly, but this one, I think, has nationwide importance. This is an Office of Tax Appeals case regarding Amazon, basically, FBA sellers, right? The sellers in Amazon's FBA program, and where they are doing business in the state of California. Okay. So, basic issue. This is the appeal of Diet Standards, LLC. This is OTA case number 236-13542. And this actually came out in October, but it got publicized some this week. So I'm going to pick it up. This matters to any client selling goods who uses a third-party logistics program. Amazon has the biggest one. That's why it's important. The third-party logistics relates to the fact that you give your inventory to Amazon. Amazon then determines where to stock your inventory, and they're going to move it closer, based on where they think that there'll be actual sales generated. And since California is the largest state in the nation, there's a good chance that some of your goods will end up being inventoried in the state of California, which is what happened here to Diet Standards, LLC. Okay. Now, this taxpayer was really small. I mean, very, very small. They only had $2,300 maximum inventory in the state of California during the year, and they had a total of $14,000 in sales. Both of those are way below the statutory, basically economic nexus levels in California. But California has a law, which you may see other states fall to as well, that says economic nexus is not the only way to be doing business in California. But this company, knowing they had such minor sales in California, even though they got the notice from the California Franchise Tax Board demanding a return, they ignored the notice. That's never a good move, but they did because they believed they were too small to matter. And it didn't matter. And, their sales were below the thresholds. So they didn't need to file in California. Turns out that's not quite the case. The California Franchise Tax Board looked at the legal standards, and they see that there are two separate legal standards under Revenue and Taxation Code, Section 23101. The first test under Subdivision A is whether you have active engagement in the state. Are you actively engaging in any transaction in California for financial gain? That is considered a separate test. The B test is a bright line. If you don't trip over A, then we look at B, which provides an economic nexus safe harbor. And the economic nexus safe harbor was way above the level of sales that this company was generating. I mean, well above it, essentially 20 times. So this company is way below the threshold. Now, they thought because they were so far below the thresholds, they're safe. But the Franchise Tax Board and now the Office of Tax Appeals in California has essentially said no. Sorry, you meet A. You're not protected from A by B. Rather, B is a second way California could tax you. But if you fall under A, we don't even look at the B test. Having inventory, the bottom line, having any inventory in Amazon's warehouses in California constitute active engagement in business. That was a holding of the OTA. It does not matter how small that inventory value is. Any of your inventory ends up in California, you are engaging in business in California. Now remember, Amazon's moving it there to have it close to customers. Like I placed an order today for have a failed light bulb that was actually one that was on my Google Home network. So I need another remote control light bulb. So I placed an order with Amazon today. That light bulb is going to arrive, at my door by 5 p.m. Great. Except the only way that's true is because it's sitting in a warehouse here in the Phoenix area, right? They have these things around the country. So this small company in Delaware had $2,300 of inventory at some point in the year sitting in the California warehouse. And why it's important in California is there is an $800 minimum tax for every LLC that has business is operating in California. So despite their very, very low de minimis activity, they owed a $400 minimum LLC tax. Now, obviously, given the logic of this holding, they might have had $200 of sale in California, but they're going to owe an $800 minimum tax. That's how the rule will go. So this, shall we say, essentially means that almost anybody selling through Amazon's program where Amazon manages your inventory and allows your customers to get that really quick delivery, they probably should be filing a California return. Kind of hate to say it. Now, the taxpayer also got hit with the demand penalty because they ignored the letter. Ignoring letters from a taxing agency is never a good idea. No, but from most government agencies is not a good idea. And the fact they weren't aware and they were ignorant of this rule is, not reasonable cause. You should never ignore a demand for a tax return letter. At least respond. Even if you don't think you owe it, respond. Not responding puts you into big trouble. Again, in this case, it wasn't that huge. I mean, it's about another $300 and some that they got tripped over due to interest and this demand penalty, but still not a good idea. So, key thing for those of you listening today is review your client list for e-commerce sellers and figure out if they're using a program like Amazon's where their inventory could end up in California. And I should add, watch for that in other states. This is one of the unfortunate consequences of the fact the Supreme Court did not eliminate the test we had in Quill, where physical presence is considered to be enough. It was physical presence was our test. If they use Amazon's FBA, it is highly, highly likely they have inventory in California at some point during the year. I mean, that's the biggest place to sell. You got to believe they'll be there. You got to believe there's also a good chance they'll have inventory in New York, in Texas, and there are some issues even there you can run into. You might. Now, again, currently, those places do not seem to be, although Texas is known, they did for sales tax go after that for quite a bit. But you may see other large states realizing that they can collect this money, starting to get into this. And even not just, large states, just near large cities. Arizona, a lot of your clients probably have inventory in Arizona. Phoenix is the 5th largest city. Maricopa County is up there about number 10 with population nationwide. We had a lot of people. So it's in a lot of places that you may have that inventory. Even if you sell very little, certainly for California, you likely owe the $800 minimum tax, but also consider your exposures in other states, especially ones that are known to be aggressive in pursuing out-of-state sellers. Finally, let's take a cautionary tale involving 2 attorneys. And one was a CPA with an LLM in tax, right, who failed to substantiate real estate professional status. This is the case of Mirch versus Commissioner, Tax Memorandum Case 2025-128. Decision came down December the 11th. Now, interesting aside, this becomes a collection due process case, right? The taxpayers missed the original deficiency notice, and they did so for the dumbest reason, but it was missed. Okay? Review your tax returns carefully before filing, especially if you're not pro forma-ing information and you're typing in an address. I'm just going to say. What they were trying to do ultimately, though, so the case was because they never got the deficiency notice, the original one, it was sent to their last known address, the tax court reviewed the liability de novo. That means, basically re-reviewed the whole thing as, giving them their first chance to challenge the underlying liability. And what these 2 attorneys, they're married couple attorneys, they were trying to use rental losses and carrybacks to wipe out the income, claiming that the wife was a real estate professional, right, under the real estate pro rules we have under 469. Now, few mistakes they made in handling their return. By the way, they're also handling their tax court case, so it's a do-it-yourselfer. Now, they're attorneys, but as we may note, sometimes if you don't specialize in tax, if you're an attorney or a CPA, you might find that you're going to skip a few things you shouldn't have skipped. Their first mistake was they never filed a formal election to aggregate their rentals, right? That means under the rules for the real estate pro, each property is separately tested for basically, for material participation and is tested separately. That makes it much harder. Remember, being a real estate pro does not automatically make your rental properties material participation. Rather, it makes them not automatically not material participation, right? You're allowed to test them. That's all it does. So the problem is now they got a problem. They have 2 rental properties, and they've got to show material participation for each one standing on its own. Also, remember, you have to prove that you're a real estate pro by showing, even for a married couple, the one spouse, in this case, the wife, that she qualifies as a real estate pro. You can't combine any time that might have been devoted by her husband to the real estate activity because that's not allowed. When we get to material participation, we can do a double up. Not when we're testing to see if there's a real estate pro involved, right? And what they did, instead of filing a formal election, they just grouped them together on Schedule E. That is not how you file the election, right? Regulations pretty clear on how you file this election. They failed to do it properly. So now we're not grouped. That's bad news. Okay. And then they have the problem that inevitably it comes up in every one of these cases that we find. Logs. Their time logs were absolutely fatal. to showing material participation. They had logs that used, as the court called them, ballpark guesstimates, right? A couple of things were big problems. They claimed 7 hours to clean a unit whenever a guest left the unit, when it was short-term rent, was very short-term rentals. Whether somebody stayed in that place for 1 day or 14 days, they claimed 7 hours of cleaning necessary. Now, the court also noted that they also paid professional cleaning service. So, the idea that somehow every time somebody left, it took 7 hours of the wife's time to, basically handle the cleaning, that didn't make sense to the court about that. They also claimed 8 hours a day for being on call whenever a place was being rented. Now, while on-call time may count, if you're going to talk about overtime for an employee, it doesn't count for purposes of material participation. Merely being on call, she could have been called. Only actual time works in that case. Now, because of that, we take out her 7 hours, for every time they cleaned, and we take out her 8 hours per day for having to be available. She no longer had 750 hours in total real estate activities. That meant she failed the 750-hour test. She was not a real estate pro. He wasn't, because we weren't even claiming he was. She wasn't, because she didn't have any way to prove her hours, right? She couldn't show 750 hours, so they're not real estate pros. Well, that's a problem, because you're not a real estate pro. Rental real estate is automatically passive. Okay. So they try a second way to try to at least salvage the short-term rental, right? They said, look, what we say, under a short-term rental agreement, if it's less than 7 days on average, that removes the activity from a rental activity and makes it a standard. This is kind of how you can get yourself into more being tested like a hotel. But even if you do that, it's not per se passive under the rental rules, but you still need to show material participation, right, under one of the 7 tests. And generally, most of the tests, except for the one that you did everything necessary, and we already said they hired professional cleaners, so that one's out the door. We're down to just 6. Every one of the other tests requires showing you had at least 100 hours in the activity. But in this case, because their logs were, as the court referred to them, junk, right? We can't do them. They couldn't even prove she had 100 hours there. Therefore, the losses were passive because they couldn't come up with any way to show that they met any of the standards for material participation. They couldn't prove any time on her behalf. And you got to at least show you did something, right? Couldn't prove it. We're kind of done. And also, we have those issues. And there was an NOL carryback, but that was denied because passive losses would have been absorbed in earlier years. So essentially, that didn't help. So what do we look at now procedurally? Procedurally, the other problem they had, which was amusing, was the taxpayers put the wrong address on their own tax return. They were off by 1 digit. Kind of interesting, but they had 1 digit off on their address. So instead of, let's saying, our new address in Phoenix is 4201 North 24th Street for our office. If we kind of screw that up and on our tax return for this year, we put on there 4202, well, that's 1 digit off. But if that's on our tax return for this year for the company, IRS can send a notice there until they get a correction. And 4202, that's not our address and probably wouldn't get to us. Having enough fun right now with forwarded mail because already mentioned about our postal service fund with the post office. The post office in the one we used to use in Arcadia said, oh, there's no problem, everything's set up. But then when it turns out that our mail was not getting forwarded, going to the wrong place, then we said, oh, we had to go back and get that redone with the, with the post office. We go back, we ask them, say, well, we can't take care of it. You got to go talk to people in Buckeye. Tried to do that. Also tried talking to our new post office. Also got to go talk on Buckeye story. All kinds of back and forth. Maybe we're getting a letter. Maybe things will be forwarded now, but we're not totally sure. We're hoping this. right? So it's always a problem, right? The IRS sent those notices for these taxpayers. They sent it to that address, off by one digit. Not surprisingly, because it's certified mail, we need to go get a signature. It was never delivered because that wasn't the right place to deliver it. So the tax court held a typo on your return still establishes your last known address. It may not be a real address. I don't think there is a 4202 on 24th Street. I have to go check. There is one on 32nd Street. I know that. I pass that one when I drive down that road here in Phoenix, but I don't know on 24th Street there's 4202. And if there is, doesn't get delivered there. Maybe a high likelihood because it is one that is the first one after you go 2 blocks up or 1 block up from Indian School Road. But still, it may not exist. Even though you don't get it, it was sent to your last known address. It was not the IRS's mistake. It was yours in that case. What they issued was 3729 instead of 3728 for their address on the return. So check those typos, especially like our return this year. We want to make sure that we send in our corporate income tax return, that we make sure we actually, it was already sent in before we moved. So we sent our change of address, but it would be really important to double check that change of address notice, to the IRS actually had the right number. And hopefully they process it, unlike the fun we're having with the Postal Service. But that's a long story separately. This has been the current federal tax developments for the week of December the 15th, 2025. Again, you can contact me, Ed Zollers, at thomaszollerslynch.com. You can send me notices in that case to see or send me questions. I'll see if I have time to answer. This time of year, I'm in better shape during tax season. Things get a little hairy. I also do look in on the groups, the Connect groups for the state societies in Arizona, New Jersey, Idaho, Illinois, and Washington. So if you post some questions there, I'll try to respond. Otherwise, we'll be looking back next week. We'll be at the 22nd of December, getting very, very close to the end of the year. Again, we're coming down really to the last half of December. So, all that tax planning needs to be implemented here shortly. So keep that together. We will hopefully talk to you. See you next week here on Current Federal Tax Developments.